I'm joined today by Stephen Brown, CEO of SDI PLC. Stephen, welcome.
Thank you, Tessa.
You've been in the business for over a year and at the helm since January. For investors that are maybe not as familiar with SDI, can you just give a brief overview and tell us about the breadth of the business and the technological expertise that sits within SDI Group?
Sure. SDI is a group of small to medium-sized companies that produce specialist industrial and scientific products for growth sector niches, which of course help solve customers' key requirements and regulatory challenges. From a personal perspective, I'm incredibly proud of the strength of the portfolio and the opportunities that exist within each of the businesses. This is combined with a strong SDI reputation of delivering value-enhancing acquisitions. When I joined just over a year ago, what struck me was the quality of the businesses and the individual management teams. This is all fueled by my confidence and the potential of the group going forward.
And we've been hearing from some of your competitors some of the difficulties in the end markets, particularly in lab equipment. Can you just tell us how you've navigated some of these external challenges?
Yeah, of course. A key strength of SDI is the resilience that comes from the diversity of markets in which we operate. Earlier this financial year, we did encounter challenges in the lab equipment market across the board, but we were able to foster rapid recovery due to the market diversity.
Just looking at SDI, it's historically been known for its buy and build model over the last 10 years, comprising various businesses in the scientific and technology sectors. But looking forwards, can you just say what is the strategy of SDI and how is that translated into a sustainable operational reality?
The strength of our historic business model is underpinned by several advantages that we must use to leverage. These include us having an agile federated structure at group level, our portfolio of profitable and cash generative businesses, our diverse portfolio of companies not relying on a single sector or region, and we have the resources to invest for organic and acquired growth as opportunities arise.
Can you tell us a bit more about what you did as part of the strategic review that I understand has now been completed, and what exactly has been implemented as part of the new strategic framework?
Yeah, of course. I think it's best answered by me explaining both the two halves of our evolved strategy. Our organic strategy, in other words, our portfolio. The individual businesses are largely operated autonomously, having their independence, brand, and culture protected. We focus on our identified higher growth potential businesses, ensuring that they have capability, capacity, and market opportunity to grow. Now our inorganic strategy, in other words, our M&A. We have grown a deal flow pipeline of high quality, robust, profitable, mature businesses that will be incremental to the group. In terms of acquisition size, they must be impactful with a target EBIT of around £1 million. When they come into the portfolio, we seek to amplify acquisitions with double bumps, meaning their integration into the group will provide support for market and commercial growth to existing portfolio businesses.
Thank you. And we've talked a bit about the strategy that's now in place, but what are the long-term growth drivers for SDI?
Hitting things back, we understand our motivators. We are a buy and build business with focus on both organic and inorganic growth in tandem. So driving strong cash generation is ultimately the key requirement to facilitate a buy and build model.
Just on that, I think one of the key attractions for investors has been the levels of cash generated from the business and of course the ability to fund acquisitions. But can you say any more on this going forwards?
We're fortunate enough to be strongly cash generative, and combined with a revolving debt facility, we have adequate firepower for acquisitions. Also, we have the luxury to manage to convert most of our profits into cash, and we aim to keep our balance sheet net debt to EBITDA covenant between 1 and 1.5 times.
And just on M&A, can you tell us a bit more about your criteria for buying businesses?
Yeah, of course. I would say that we're not an ego-driven nor forced acquirer, and we're looking for quality established businesses with strong existing management teams that not only meet the SDI criteria, but also has to be right for the group. We have a clear criteria driving activity, and you will have seen our recent acquisition closed for InspecVision that nails exactly what we're talking about.
Thank you. Can you just tell us a bit more about your most recent acquisition of InspecVision? Where does it sit within the group and what sort of opportunities do you see going forwards?
And InspecVision sits squarely in our industrial and scientific products pillar. InspecVision is an incredible business located in Northern Ireland. It defines exactly what we're looking for from the target acquisition. They produce precision measurement machinery and for smart manufacturing, automated inspection, and reverse engineering, and offers the group with an entrance into the high value metrology market and a global blue chip customer base. They are a well established business with strong brand recognition in the industry, nicely profitable, with a strong, talented workforce and, of course, management team.
So you clearly have strong access to capital and a healthy balance sheet to support the active M&A pipeline, but can you just talk a bit more about the acquisition opportunities?
Yeah, of course. Over the last year, we've worked tirelessly to build a strong deal flow pipeline to support our M&A aspirations. Clearly, there's very little value in having an inorganic strategy without deal flow to realize that. We currently have around 37 businesses in that pipeline in various geographic regions and have an established process to move the right businesses through to close. Acquisitions that remain part of SDI's DNA going forward, and this will be a continuous process.
And just looking at the underlying business, you recently resegmented the group and introduced a very clear mandate to grow the business by organic growth and by acquisition. But can you tell us a bit more about this?
Yeah, earlier this year, we announced the segmentation of our portfolio into three main pillars. That's lab equipment, industrial and scientific sensors, and industrial and scientific products. They are intended to support collaboration, knowledge transfer, enhance growth and profitability, including routes to market and operational economies of scale, both within the pillars and across those pillars also.
And can you just tell us a bit more about how this is progressing and maybe expand on any of the operational efficiency initiatives that you put in place to support margin growth?
Yeah, from an organic growth perspective, we've made pleasing progress in actively fostering synergies between portfolio companies operating in overlapping markets and or offering similar products. As an example, the senior management of SafeLab and Monmouth have been combined. The two individual businesses are now working closely together and will be benefiting from structural and operational economies of scale. Also, other businesses within the lab equipment division are increasingly engaging in white label partnerships to secure larger contracts. This also feeds acquisition opportunities.
Thank you. And just looking at acquisitions again, just looking at the other side, what are the benefits for portfolio companies of being part of SDI Group, and why would a management team decide to sell their business to SDI?
Of course, this is something very important to us. There are several strong motivators that a potential target could consider should they sell to SDI. These include them retaining their business's independence. Also, we support the portfolio business's strong financial health, enabling them to invest and provide access to specialist resources within the group, depending on their need. In addition to this, we promote and encourage the sharing of knowledge and expertise across the group companies, as well as potential cross-selling opportunities and synergies.
Some of your more recent acquisitions have given you a broader geographic reach also. Can you say any more about further geographic expansion opportunities?
Yeah, although the group is mostly UK based, we trade in multiple sectors and geographies. Around 40% of our products go directly out of the UK, but we estimate actually that more than 60% go internationally. We have direct presences in Portugal, Germany, China, and the US, and clearly growing these would support our organic growth aspirations.
Just to finish off with the conundrum between M&A and organic growth, can you just end with your thoughts on how to balance this and maybe any closing comments on SDI?
Yeah, so we regard both M&A and organic growth as equally as important, which perhaps is a slightly different focus than before. We will look to succeed in both of these areas. The two complement each other. Strong organic growth, strong cash generation will provide SDI with the ability to acquire more companies. Acquisitions provide additional cash flow, and this growth loop will enable SDI to grow strongly. As I said earlier, I'm incredibly proud of the strength of their portfolio and the opportunities that exist within each of these businesses. As we continue to execute the strategy that I've outlined, I look forward to seeing all of our stakeholders benefit from the inevitable benefits that will follow. Clearly, I remain excited about SDI's future going forward.
Stephen, thank you very much for joining me today.
Thank you, Tessa. I appreciate it.